This conference will now be recorded.
Okay. Hey, hi, Vishu. Good afternoon, and welcome back to a fresh new session on credit risk modeling. Before I move on, right? So even though it is work in progress, I'll show you the location of the drives, and I'll share the same with with the batch, right? So I have kind of prepared a location, right? So for all your content. So it's not that I have prepared it exclusively for your batch, but so some of it was already there. So I'm just kind of updating all the folders uh, so that it can be so that you can start using it. Okay. So over here, so this is the folder of interest that you have, right? So it is the credit risk model development and validation folder. Now in this folder, we have seven main folders. Okay. So one of them is the code sheet folder where you have all your code sheet and notebooks saved. The second that you have is the log folders. So basically from where the logs come out, the log of the SAS logs are saved there. Then what you have are the data sets and so the relevant data sets which are used for model development. So all of them are archived there. Then you have the model validation recordings. So which contains all the recordings of the subject wise or the topic wise recordings of all the batches. I mean, of all the topics, day to on a day wise basis. Then what you have is the readings and references folder, right? Then readings and references folder, which has all the reading documents and stuff. And then you have a seventh one, which is the credit risk model development validation questions and references folder, questions and answers. So whatever queries you have, you can just upload it in a document over here, and the participants can discuss. Right. So over here, so let me just walk you through each of these subfolders, right? So over here, I have six subfolders within the code sheet folders. One of them is for the predictive modeling methods. So which is like this. So when in SAS, when we are studying, we study the predictive modeling methods as well, right? Like the central tendency, dispersion, and so on. So all those codes are saved over here, right? For model validation. So the SAS programming portion is saved over here. The predictive modeling, descriptive analysis is saved over here, statistical inference, and linear regression. So up to this point, it has been done, and all these code sheets are kind of saved over here. The next thing that you have is the Python primer. So basically, over here, all Python notebooks that we prepare will be saved over here, right? So that's the next part. So over here, all kind of codes and notebooks and everything is saved over here. So similarly, application scorecard code sheets will be saved. Behavior scorecard code sheets will be saved. So it is saved to some extent over here, right? The regulatory model code sheets will be saved, and stress testing and development code sheets will be saved. So it's still in the process of being updated, right? So this is the code folder that we have. Now, similarly, the logs generated by the respective codes are summarized over here. So these are some of the things which we need to take up, right? Okay.
All right. Yes.
Right. So similarly, over here you will have the data set. So I mean still in the process of doing it, but the initial data sets are here. You can take them and you can start practicing. The code sheets are there. So all the data sets, the SAS format is saved here. Right. So I will be walking you through like what data sets to use, when to use, what to use, and so on. Now the best part to start off with is the so this is where all your videos are saved, right?
Okay.
right? So over here you will get, so once you open this, so these are the introductory videos to credit risk model. So 6, 7, so how application scorecards are used, behavior scorecards are used, what are the basics of banking and all. So these introductory videos are over here. Then you have the SAS videos. So the videos which has been done for SAS programming. So those, you have 33 sessions on SAS which has happened. Right. So that is uploaded over here. Next you have the Python session. So 3 sessions has been done for Python and 2 more will be done. So these are from the other, so the morning batch that I do. So I keep on uploading their things over here in this folder, right? So you have the modeling validation introduction to Python. So today I was doing the data types, the data sources of Python, like the data structures in Python, like tuples and lists and sets, like that. So those will be, they are also a part of this, right? Now, over here, then we have the introduction to predictive modeling methods for credit risk. So over here you have the introduction to the method of descriptive statistics. So there have been 6 sections on descriptive statistics. Then we have completed around 15 sessions for probability theory. Right, so probability theory, we started from the classical theory of probability. We have discussed the axiomatic theory of probability, and then we have gone to talk about the mathematical theory of probability. Right, so after finishing that, the next thing that we are currently doing is we are talking about the applications of credit risk modeling and validation on and decision tree methods and so on. So this is the part that we are currently doing. So all these videos are getting uploaded as we are moving, right? So I believe you have uh, and the content that the sessions that we are doing, we have started off, we are talking about the regulatory modeling side of it, right? So over here I will add a folder which will talk about the regulatory modeling part, right? So like we have the third is the Python one of regulatory modeling. Okay, so over here yeah, so over here I have created it for you know for behavior scorecards, right? So and then so as I finish the acquisition models, I'll also keep on updating it over here. So what I will suggest is that you kind of start working with these. You start going through the videos one by one, and whatever assistance that you need in terms of replicating the codes and all, so you can start off with that, right? So right, so all these videos are kind of arranged in the order in which they need to be done, right? So you have the behavior scorecard videos and pretty modeling. So you start on with the basics and you keep on going down, right? So you will. So that's the way the module has evolved, right? So you can start off with your own learning exercise. You can do it parallelly as we are doing the credit risk module. So as we started off with the regulatory model, right? Now after that we have all the validation reports and summaries. Whatever Excel reports are used in those videos, they are available over here. Right. So then you have the readings and the references. So over here you have the readings and references on statistical methods. So all those, so so these are pretty well written out notes which are there on the drive. You can start referring to them as well. Right. So you have pretty well defined notes over here. Right. On descriptive measures still above. Right. So you can always start and have a look at them. Then you have some ebooks and PDFs which you can also look up. So So there is quite a bit of it, and I'm finishing it off. So I hope to finish it off by end of day tomorrow, so that you can also start starting. So you guys can also get going with it, right? So this is the readings and references folder, and then you have the questions and queries, right? So I suggest that between Monday to Friday, when you have time, so start off with each of one. So take up one of this video sections, start finishing it by topic, and then you start moving back to the data, the report, and everything. So that is what I think is going to that is what may benefit you as well, right? So is
Yeah.
this yeah, we should any questions around this part?
Uh, uh, no. So once you share the link, so what I'll do is I'll start. I mean, the regulatory modeling,
Yeah,
whatever
so I will
you are.
share the link right away over
No,
here.
so yeah, what I'll do is that uh, so you are going over the regulatory modeling side of it. So
So
this is the other.
I'll start with the batch, yeah, on the regulatory side. I'll dig deep into that. So while I dig deep into that, I think you
Yeah,
can
yeah,
start off with the other questions.
yeah, yeah. So that is what I'm saying, that you are already going over one side of the aspect, right? The
Yeah.
other half, I'll start going over, and
So I
when
think
you
that way you can entirely expedite that entire whole process.
yes, I agree. So by the time you start teaching all these things one more time, I mean, I mean, already be over them, I believe.
Over them, right? So that we can have a quick discussion and we can kind of wrap it, like finish it off. So if you have any questions and queries stuff, as you are progressing, we can set up time during the weekdays and we can get it clarified.
Yeah, yeah. I already started going over actually the introductory videos that you have shared,
Okay.
right? So there it has like 36 hours of content. So I am just before the roll rate analysis. So
Okay.
okay. So there I just see what I thought of doing is just go through the breadth first. Okay. Not get
Correct.
stuck with one video. Just watch one video and see that what the entire spectrum is, then revisit one more time and note down the questions, and one video the questions, and the questions will be asked to you that what, these are the questions from this video,
Exactly.
what do you feel about it?
Exactly.
All right, yes, thank you.
Right. So I think that will be a better approach so that you can, like, if you can speed it up by the time I finish the regulatory models, I think you should also be in a position good enough to kind of work on the other sides as well. Now, the second reason as to why I handed over this material over here in this current, so as a part of the sessions, is that over the next 2 3 weeks, there can be some irregularities from my end. Okay,
Okay.
possibly.
Mhm.
I will
Okay.
obviously inform you beforehand, right? But what I don't want is that your preparations or your studies to get stuck. So whenever I'm unable to figure things out on the weekend, I will assign a class on the weekday and I'll do that, right? I will try
Okay.
not to miss 2 sessions on the weekends, but if I miss at least one, say let's say I miss one, I can pull it up over the weekdays. So that is something that we would
See,
so that's
yeah,
something that we would have.
mm, see, you are a working professional, okay? So sometimes it happens. Even I am going over the the OR logs now. So
Yeah,
I am
actually, the
working.
thing over here, Biswarup, is that along with the work side, I mean, there are things going on in the personal side as well, right? So
Yeah, it can
that's what
happen.
is making. Huh. So that is
So
why I
all,
don't want the classes to get stopped. So like so that so none of us get stuck somewhere. So you can at least have the content with you. You can start going through that, and also that's quite
yeah,
a bit of a heavy content because it will take time.
it will take time. For sure, it will take time because see, learning a new domain always takes time, and uh, I can I can relate what's happening, but definitely it is new. But the point I'm trying to say is that see, it can happen that you are busy. Okay, there is nothing wrong in that, and you are already covering for it. And if you feel that 1 hour, two sessions in the week, and rest of the part will be covered in the weekend, it's fine. Then we can stretch. As in, I'm all right to stretch a bit in the weekend,
Yeah,
and
so
if
because
you want
this
to
batch is
continue,
not a
continue.
very large batch, because this batch is not a very large batch, and there are just two, three of you, and both all of you can be coordinated over the weekend, and you at the same time zone. So that makes my life a little easier,
Hmm.
right? Yeah. So
Yeah.
that's just a heads up. Maybe
Yeah. Yeah.
I don't, and I may it may so happen that I miss nothing, or it may be that I'm
Hmm.
unable to take two weekends of sessions together. So
Hmm.
anything can happen. So I'm just giving you a heads up that possibly this can happen so that you are also like
Yeah.
a
Yeah.
bit mentally prepared on your side. Yeah.
Yeah. All right.
Okay.
Yes.
So
Thank you.
let's get started.
Yeah.
So you can go on mute and I will do this. Okay. Okay. So as we were discussing, right? So let's just have a very quick recapitulation of the discussion that we were having, and we will pick it up from there. So so in the last session that in the last session that we were talking about, we started our discussion on the premise of the loss distribution, and we started exploring the different nuances of the loss distribution. So we started identifying that. What we did was we started identifying the idea of the loss distribution. That how exactly is it that a loss distribution would work out. So what are the components of the loss distribution? Why is it that the loss distribution is stretched? I mean, is skewed towards the right hand side. And then we spoke about the concept of the total loss. So while we spoke about the concept of the total loss, we said that the total loss is the summation of the expected plus the unexpected loss. And from there, we identified the fact that the total, this expected loss is captured by the provisions, and the unexpected loss is captured by the capital. Now, in order to address that, how, why this, in order to address how exactly is it that these provisions and the capital are you know so how exactly that this provision and this capital is interrelated with each other. So how is it actually interrelated with each other? right? We see that the so we have the profit and loss. We try to assess the profit and loss statement and the balance sheet of the bank, right? So these are the two most basic financial statements that the bank has, right? So these are the two financial statements of the bank. Now over here, the profit and loss. So what we need to do is we need to understand how exactly is it that this profit and loss and the balance sheet of the bank will work out, right? So, so what does the profit and loss statement of the bank comprise of? What does the balance sheet of a bank actually comprises of, and how do they relate to each other? So that's the part that we are trying to talk about, right? Okay. Okay. So over here, so let's start off with the idea of a profit and loss. The profit and loss statement. So what does the profit and loss statement of a bank actually comprise of? What do they have? The profit and loss statement of a bank comprises of two parts. One is the income that the bank earns. The other is the expenditure of the bank. The expenditure of the bank and the sources of expenditure, right? Now, the income that the bank earns is divided or has two broad types. One set of income is the interest income that the bank earns. The interest income that the bank earns. And the second that we have over here is the non-interest income. The non-interest income. So the interest income that we talk about is that interest income, which is which the bank earns from making profits, right? So which the bank earns from their lending practices. So when the bank lends the money, lend funds, they the individuals have to pay an interest on that, and from there, what you gain is your interest income, right? Okay. And non-interest income comprises of the income from the fees of the bank, fees, uh, penalty, fees, penalty, etc. Penalty, etc. So we have an interest income and we have a non-interest income. So the interest income is the income from lending, and non-interest income is the income from the fees, penalty, etc. Now the expenditures that we have over here comprises of two parts. One are the operating expenses, salaries, electricities, etc., etc. The operating expenses. So one side we have the operating expenses, and the other is the provisions. So provisions are nothing but these are these are funds which the bank sets aside in order to absorb the bad debts, right? So the second part over here that we have is the provisions. Is provisions. So these are the key themes these are the key factors that we would have. The first that I have over here is the interest income and the non-interest. Right. So when I talk about the interest income, when I talk about the income and the expenditure, the income comprises of the interest income and the non-interest income. The expenditure comprises of the operating expenses and the provisions. Okay, so we have the operating expenses and provisions, right? So this is how the profit and loss statement of a bank is structured. So one thing that you can see is that the profit and loss statement talks about, or it helps in accounting uh, the profit and loss, and so how much has the account so how much of the interest income has been given. So what is the income that they have earned, what is the expenses that they have incurred, and so on. So these are some of the portions that we talk about when we talk about the profit and loss statement of this, when we talk about profit and loss statement, right? Now comes the next part, which talks about, which is the balance sheet. So the next question that comes out over here is that what exactly is the balance sheet? Okay, so when I talk about the balance sheet is about the liabilities of the assets. Right. So on one hand, you have the liability. The other hand, you have the assets. And the third that I have over here is the okay. Okay. So over here we have liability, capital, and asset. So let's try to see what these are. So obviously, asset is something which is, you know, so which adds to the the financial stability, and which which improves the net worth of the so which improves the net worth of the capital, and which improves the net worth of the bank, of the financial institution, right? Okay. So over here, so out of the assets and the liabilities, right? So it's a statement of the asset and the liabilities that the bank has. So obviously the liabilities are the ones which increases the, or which has a negative impact on the bank, right, on the balance sheet of the bank. So over here, we have the capital, right? So in terms of the capital, we have two things, right? So one is the liability. So the liabilities, which shows the which shows the burden that the bank has, so which would reflect a cash outflow, and an asset would reflect a cash inflow. So over here between liability and asset, right? So the third component, and which is the one which is of most importance to us, is the capital of the bank, right? Now, this capital of the bank comprises of two parts. One is the tier one capital. It has the tier one capital. Then what we have over here is the tier two capital. These two layers of capital taken together turns out to be the regulatory capital. The tier one plus the tier two capital taken together is something is which forms the regulatory capital. Over here, what you will have is the regulatory capital. So it has the regulatory capital. Right. So over here, we are concerned about this regulatory capital, which is the tier, which is sum of the tier one plus the tier two capital. So as we move forward, we will see what are the key components of this tier one and tier two capital. But for the time being, now just let us try to understand why is this capital important. So basically, one thing that we said is that the unexpected losses are absorbed by the bank's capital, right? And that capital comes from the balance sheet. So obviously, one thing that we can see is that between the profit and loss statement and the balance sheet, there has to be some relationship. So one thing that we need to explore over here is what exactly is the relationship between the profit and the profit and loss statement, the provisions which are calculated from PnL statement, and the capital which is calculated from the balance sheet. So let's try to understand that particular part, right? Okay. So we what we'll do is we start we look at a kind of a flow diagram, an accounting equation and in identity flow, and from there we'll try to understand the relationship that is existent between this capital and the provisions, right? And how does the provisions go on to impact the capital? So that's the part that we are trying to capture, right? Okay. Okay. So just give me a minute's time. I'll just be back and we'll get started on this relationship. So just give me a minute's time.
All right.
Hello.
Yeah. All right.
Yeah. Thanks, Vishu. Just give me a minute.
This conference will now be recorded.
Okay. Okay. So after the break, so let's just yeah. So now let's try to derive the relationship between these provisions and the capital. Okay. The first step that I have over here is the pre-provision net revenue. So the first point that we have over here is to receive or the first step of this of any of these calculations is so involves computing the pre-provision net revenue. Now this pre-provision net revenue is very famously called the PnL. Right. So the next question that comes over here is that how exactly is it that this PPNR is calculated? Now when I'm computing the PPNR, I'm computing it as follows. So first what I have is the total interest income. That is the total interest income. Or let me not use the term total interest income. Let me use the term the net interest income. Right? So the PPNR will be the net interest income plus net non-interest income. Right? So the net interest income plus the net non-interest income is a part of the total or the total net the net income that the bank earns minus the expenses. Minus the expenses, or as they call it, the expenditures. Now, when I look into this, one thing that we see in the PNR, so this is the net revenue that the bank has earned before it is adjusted for the provisions. So before you have adjusted it, before you have really adjusted it for provisions, you will see that the net interest. So you will get the pre-provision net revenue. So this is the revenue that you charge before you are adjusting the revenue or the net revenue for the provisions. Right? So this is step one. So this part shows that okay, this is the total net income that has come in, this is the expenditure that has gone out, and after you have adjusted the two, whatever you get is your PPM. Right? Or you get your pre-provision net revenue. In the next step, what you are doing is you are adjusting it to the provisions and you are obtaining the before tax net income. So after you have adjusted it for provisions and for other, you know, the trading losses or counterparty losses, what is the remaining amount of income that you would have? So that's the step two. So the second step is to move from a PPNR to a pre-tax net revenue or pre-tax net income. So over here, what we are trying to do is we are trying to calculate the pre-tax net income. So what I have over here is I have the pre-tax net income. Now, when I talk about the pre-tax net income, what is it? So first of all, to the PPNR, or the pre-provision net revenue, net income from from counter from trading and counterparty losses are adjusted. Right. So whatever the losses has been made from counterparty minus net counterparty losses. So this is the part where your market risk factors are also coming in. Or trading account losses. So from here, so to the PPNR, what I did is I adjusted the counterparty losses or the losses to the trading. Now to this, what we do is we adjust the taxes. Right. So what we have is PPNR, we have the net counterparty loss, trading account loss minus the taxes. So this is the pre-tax. Sorry, this is the pre-tax net income. Sorry, I have made a mistake. It's not the taxes. It is the provisions. The provisions. It is minus the provisions. Right. So the pre-tax net income is calculated by adjusting the provisions and the net counterparty losses to the PPNR model. So the PPNR outcomes that comes in, to that you adjust your provisions and your net counterparty loss. So what you will get over there is you will get your pre-tax net income. So as a result, over here what we are trying to do is we are trying to fetch out the basic idea behind the income. So how does the income of the bank flow from one point to the other? Right? So how does that income flow? The flow of that income is tracked through the PPNR or so this is tracked through the movement in the income. So the income flow is, and it is tracked at each level and is obtained, and you reach to a final value by adjusting the respective factors at each stage. So first what you have is the pre-tax net income. The third point that we have over here is the after-tax net income. Tax net income. Okay. So what we have is we have the pre-tax net income. So to the pre-tax net income, the third step is to adjust the tax. For the after-tax net income is nothing but the pre-tax net income minus taxes. So what I have done over here is I have adjusted the taxes. So what we have is we have the after-tax net income is the pre-tax net income minus the taxes. So we have three levels. First is at the first level we are deriving the PPNR. So PPNR is adjusted or is calculated by adding the net interest income to the non-interest income, adjusting it to the expenses. The second is the step two, which is the pre-tax net income, which is PDNI, and step three is the after-tax net income, which is the pre-tax net income minus the taxes. Right. So that is something that we would be looking at, right? So I have step one, step two, step three. So these are the three levels. So after the third step that you have calculated over here, one thing that we can clearly observe is the following: that this after-tax net income is the net income which so this after-tax net income is the income which is used by the bank for multiple purposes. The after-tax net income now this after-tax net income is a very important component. Why? Because this after-tax net income is used for a lot of different functions. So one of the important function is capital distribution to the stakeholders, to shareholders. Capital distribution to stakeholders. The second part is retained earnings, and these retained earnings are the ones which is adjusted by the bank into the equity. Right. So we have these two parts. One is the capital distribution to stakeholders. The second is the retained earnings. Now these retained earnings are used by these by the banks to add to their equity. So the question that comes out next is, what does retained earnings do? They are used to add, or the net retained earnings are used to add to the equity. Retained earnings are added to the equity, which is the tier 1 capital. So over here what you get to see is this creates an addition to equity. Okay. So over here what we are talking about is, so this part goes as an addition to equity. So this is the part where, you know, when we talk about the addition to the equity, so what it means over here is that this is the part which goes and which enters into the equity, and the equity capital increases. And when the equity capital of the bank increases, the regulatory capital of the bank also increases. So with this increase, the next question, so the next question that comes out is that what are the next steps in terms of the impact on the bank's capital. So over here, observe that this income which is getting generated, right, that is working on as an addition to the equity. Now, if that addition to the equity has to come out, right? So if I have to do an addition to the equity over there, so this addition to the equity is a function of the after-tax net income, and this after-tax net income is a function of the provisions. So basically, even the provisions are calculated as a part of the PnL statement. It is absolutely important that this provision be adequately adjusted, right? So it should be that this is adequately adjusted. So where is this adequately adjusted? So this provision should be, or should ideally, it should be, it should ideally be captured such that, so it should be very effectively captured, because the more optimal your provisions are, the more optimal will be your pre-tax net income, and then the better will be after tax net income, and hence the addition to the equity will be better. So the higher your provisions are, so your provisions are like expenses, your provisions reduce the reusable income, and as a result the provisions has to be made very robust, and that guideline which works along, so that guideline which goes on to make provisioning more optimum, or which goes on to ensure that provisioning done is optimum, is the IFRS 9 guidelines. Right. So the net counterparty loss, so the one that I have over here is the net counterparty loss, the provisions, and the IFRS. So that's why the provisioning has to be optimally captured, or that has to be optimally managed. And what helps in, or what is that guideline that would help them in managing that, is the IFRS 9 guideline. And that's why IFRS 9, as I said at the beginning of the discussion, is actually a very important regulatory framework, right? So that is one very important part that we have over here, right? So Vishnu, up to this point, is it clear?
Yeah, I do have few questions.
Please
But
tell
yeah,
me.
Yeah. So, Tanmay, what is this counterparty losses? So
So
when you say that,
yeah, so counterparty losses are losses arising on the from the market risk. So it's a market risk issue. So let's say, so think about it this way, that I have sold goods on credit to a person in the next sold goods on credit to a person, and what I have done is I have hedged my product using some options or swaps, right? So now that swap is, so what is that swap? That swap is a document, right? It's a paper. So which, or it's an arrangement which the borrower or which the holder of the option needs to honor as decided at a due date, right? Now let's say that this borrower defaults. So then that that borrower fails to honor its obligations, right? So then that's a default that has happened, right? And hence that's called a counterparty default. So this is very similar to the concept of bills of exchange. So previously we used to draw bills of exchange, right? 90 days bills onto the debtor. Now what happens is 90. So what it means is that 90 days down the line, the debtor will be paying me back this money, and against that I'm giving him a bank like giving him a bills receipt. So on the date of payment, let's say the person defaults, he's unable to pay the money. That is when you will see. So that is what a counterparty default is. So so these are the default which are. So this is a very specific kind of a default which is occurring on a market asset, right?
ba- basically this is a covenant compliant issue. Sorry, I mean in commercial. So you have an agreement between both the parties, and
Correct.
bank and the party, and the party on a specific day is supposed to pay something, and if he does not pay, he will enter into default. That will be counted as a loss, basically.
Correct. So that's a counterparty loss, right? Because there has
Oh,
been a default. Now, if something can be recovered from it, then that's fine. Else, it would be counted
okay.
as a loss.
Mhm. And the next question is, so when you are calculating PPNR, when you say expenses, these are operating expenses, right? Not, I mean, provisions are not included there.
No, they are not. That's why it's called pre-provisioning net revenue.
Okay, all right. The next thing is, it's a simple question. So in
Huh.
simple terms, your capital is asset minus liability, right? Or no?
Asset and liability is your capital, right?
Okay. The next thing is, so in this context, right, you're explaining the capital, the asset, the liability. What is reserve, Tanmay?
Sorry,
So what is
what is?
reserves? Reserves.
So reserves are like I mean, that's the capital reserves.
So that is basically capital.
That's basically capital, right?
Okay. Okay. Uh, the next thing is this, I mean, after tax net income is basically the actual income of the bank after you adjust for the provisions and adjust for the taxes.
Correct.
Okay. And when you say that the capital distribution to the shareholders, this is basically the dividend payout, right?
The dividend payout to the common shareholders plus the preferred shareholders.
Okay. The
I'll
next
come to that.
part, yeah, yeah. Okay. The next part is when you say that retained earnings, okay, that you now you paid out the capital to the shareholders, the preferred and the common shareholders. Uh,
Mhm.
you have the retained earning now, right? So that is basically it is with you, okay. Some part you want you distributed, some part is with you. So when you say that that is adjusted to the equity,
Mhm.
means that that is basically the capital, right?
So that's the tier one capital. So this retained earnings. So if this out of this retained earnings, A part of it would go to research development and other purposes, and whatever is left back is is added to the equity. That's a tier
Yeah.
one capital.
Okay. So basically the equity and the I mean the equity and the tier one capital is basically same.
Right. There's a tier one capital is the equity capital.
Okay. All right. Yeah, these are the questions that I had. Yes.
Yeah, because I'll be taking up tier one and tier two capital and their components very in a very distinct manner as we go forward.
Yeah, yeah, yeah. I understand. Yes. All right. Yes.
Right.
Yeah. Yeah.
Fine. Okay. Fine. So now I have this income and that is getting added to the regular capital, right? So now let's try to. So now let me try to bring this to step 4. Okay. Okay. So over here, what I have is step 4, right? So in this step 4, it shows. So step this is change in the equity capital. Okay. So when I talk about the change in equity is the existent equity capital which is there. Change in equity capital is there. To that, I add the after tax net income minus the payment to equity. Or let me put it like this. Reduction in equity due to, over here what I have is reduction in equity Okay, hold on. I'll just put step 4 and step 5 in the next page. Okay, so let's say I have this step 4. So over here, what I'll write is step 4. So I have the after tax net income. Hmm. So with the after tax net income, what I'm doing is I'm adjusting my net distribution of capital. Net distributions to common and preferred equity. To common and preferred equity. Right. So this is change in the equity cap. Okay, so this is where we have the change in the equity, right? So over here, what we have is the after-tax net income minus the net distribution to common and preferred equity, and what we have, the final resultant change is in the change in the equity capital. And if the equity capital changes, then the regulatory capital will also change. So observe that the relation. So what is more important to observe over here is that with a change, so there exists a very deep relationship between the net income, so between the after tax net income, and I mean between the income and the changes in equity capital. Now with the change in the equity capital, so the income is driven by the provisions, and how optimally your provisions are maintained, that would determine how your this thing is done, right? So how exactly is your so how exactly is your equity capital behaving in relationship with a change into this, right? So that's the part that we are looking at. So one thing that we can clearly see is, that this relationship between provisions and capital is very it's close to each other. I mean, they're very closely related. However, the question that comes out over here is, then why is it that provisions are that I mean kind of these are the expected losses, or these are managed by provisions, and why is it that the unexpected losses by capital? Because one of the things that you would see is that the expected losses are a very small magnitude, right? And the provisions that you are keeping aside against it is treated under the PnL statement. So the provision is essentially an expenditure, right? However, if it was not treated, however, if I bring in capital, now capital is used to absorb the unexpected losses, right? So in that case, so the unexpected losses are losses which have extremely huge magnitude, right? Who have extremely huge magnitude of loss. Now if they have extremely huge magnitudes, and that they are kind of uh, so they have extremely huge magnitude, right? And uh, yeah, and they have extremely huge magnitude, right? And over here, one of the things are that uh, so assuming that they have extremely huge magnitude, and given that they have this given that they have this magnitude, and one thing that we can clearly kind of see from here is that if unexpected losses were treated by provisions, then they would be adjusted in the PnL statement. And given that it was adjusted in the PnL statement, the prices of the products would have shot up abnormally, because provisions are an expense, right? So if the unexpected losses were also covered by the provisions, then it would impact the pricing of the product, and as a result, it would not be so. As a result, it would not be a good exercise, right? So that would lead to the loss of like competition, like loss of competitiveness by the bank. So therefore, the capital is the unexpected losses are absorbed by the capital, and the expected losses are absorbed by the provisions, right? And one that we see is that effective management of the provision also causes also impacts the growth of the equity of the bank, right? So it also impacts the addition to the equity that the bank can do at the end of one financial year. So that is the reason why both these two are very closely related with each other, but at the same time they are not exactly the same, right? So the final step that I have over here is step 5, because this change in the equity capital will impact the change in the regulatory capital, right? So change in equity minus the net deduction to regulatory capital. Net deduction to regulatory capital. So this will give you the final outcome, which is the change in the regulatory capital. So this is finally the outcome of, or this is finally the outcome that any risk modeling exercise or all the models and everything that we try to understand, they all together come over here to assess the change in the regulatory capital. Right. So this is the change in the regulatory capital. Now, while I talk about the change, about this change in equity, net deduction to regulatory capital change. So this is the final outcome, right? So last year I had a regulatory capital. This year I have a regulatory capital, and whether the regulatory capital is sufficient or not. So there are two things that we need to talk about over here. One is, so one of the provisions is something that we have already seen, and the second set of regulations which will come in over here involve assessing the change in the regulatory capital. And there are two types of these methods. One is the regulatory method, so one of the regulations that we'll talk about is the Basel, or the BCBS regulations. And over here we have the stress testing regulations. So we have the stress testing regulations. So on one side, I have the Basel BCBS regulations, those are the capital adequacy norms, and over here we have the stress testing regulations. Right? So these are the four, these are the steps, and so then these are the regulations. So basically, this is how the three set of regulations, the IFRS 9, the Basel, and the stress testing regulations fit in with each other. Right? So this is broadly what the framework is. So now the next question that comes out over here is that how is it that we would calculate, so given a loss distribution, how do we compute this expected loss? How do we compute this unexpected loss? And given that we are computing the unexpected loss, how do we calculate the capital? What are the components which go into calculating the capital? What are the other components that we look at? And how exactly the provision calculated? How exactly is the capital calculated finally, and how exactly is an RWA calculated? So we'll look into these two important these two aspects in the next discussion, right?
All right. Yes.
Okay. So So Vishnu, thank you for your time today. We'll catch up at 2 p.m. tomorrow, and we'll take it up from here. Thank you.
Yeah, thank you. Bye bye.
Bye bye.